The closing bell rang exactly 15 minutes ago, and here is your scoreboard for the post-holiday Monday session, July 6, 2026. The S&P 500 climbed 0.7%, printing a closing print at 7,525.89. The Nasdaq surged 1.1% on a massive tech bid, and the Dow squeezed out a 44-point gain, up just 0.1% to 52,990.
But you have to remember that 52,990 completely masks the real structural story.
Right.
I mean, the Dow actually crossed that historic 53,000 threshold intraday before aggressive profit-taking just dragged it right back down. We're looking at a classic head fake today.
Right, exactly. If you were just glancing at your screen today and seeing a sea of green, you might think it's a massive breakout. But when you look at the internals, today was essentially a mirage.
A complete mirage. Because if you want to know why that 53,000 level couldn't hold, you have to look at the macro context, right?
Yeah.
WTI crude is hovering down at $68.31, which shows industrial demand is incredibly soft.
Yeah, that's a huge drag.
Right. And meanwhile, the 10-year yield cooled slightly to 4.46%. And hanging over all of this price action is the new Fed chair, Kevin Warsh, who is keeping the street totally guessing ahead of Wednesday's FOMC minutes.
And we also had that highly unusual structural start to the session that injected some uncharacteristic momentum. President Trump bringing the NYSE and NASDAQ opening bells directly from the Oval Office to launch those tax-advantaged Trump accounts.
Yeah, an unprecedented morning sequence.
It really was, and it brought this wave of early retail liquidity into the market. But looking at where we actually closed versus where we opened, it feels like, well, it's like looking at a massive skyscraper where the roof is hitting record heights, but the foundation is crumbling.
That skyscraper analogy is exactly how portfolio managers are viewing the tape right now. The surface-level narrative push this afternoon is that today was a key reversal from last week's defensive shift. Hot capital supposedly rotated right back into AI infrastructure.
Right, because communication services jumped 1.64% today, while healthcare, the defensive haven, slid 1.17%.
Exactly. But the real risk here is when you look underneath that index level.
Wait, but if the S&P 500 is up almost a full percent, sitting at 7,525, mathematical logic says most of the 500 stocks inside that index must be having a great day, right? A rising tide lifts all boats.
But the breadth breakdown today completely shatters that assumption. The advanced decline ratio was a heavily negative 0.8. Out of the 11 major S&P sectors, 6 of them actually closed in the red today. The majority of individual stocks in the S&P finished lower.
So it's just a top-heavy, mega-cap tech hijack.
Completely. The heavyweights pulled the cap-weighted index up, and the average stock was basically left behind as exit liquidity. And without volume confirmation, the whole move is hollow.
Oh, the volume was basically non-existent. Trading desks are still totally empty from the July 4th weekend. I mean, look at Qualcomm. They traded a meager 7.29 million shares today. Their 30-day average is 27.22 million.
It's a fraction of the norm.
Right. Western Union saw just 2.61 million shares change hands against an 8.65 million average. Expand Energy traded roughly 724,000 shares versus a 3.68 million average. It was, a total ghost town.
And low liquidity in a post-holiday tape means that minor capital flows create these massive percentage swings. But if you track the real money, the institutional money flow, it gets much more cautious. The S&P 500 buy-in balance peaked right at midday, hitting a net positive $1.0 billion.
$1 billion right at lunch. But the critical data point is what happened into the close. By the time the bell rang 15 minutes ago, systematic selling algorithms trimmed that buy-in balance all the way down to positive $619.3 million.
They were actively fading the rally. Institutions recognized this low-volume tech lift, and they used it as liquidity to trim their own books. They absolutely did not buy this close.
They were basically unwinding risk into retail strength. And because the broader market didn't participate, you'd expect the volatility pricing to reflect that. Usually when the S&P is near an all-time high, the VIX completely crushes.
But it didn't crush today. The VIX actually closed up 1.14% to settle at 15.99. It is pinned directly at its summer floor.
Right. And below a 16 handle, the VIX acts like a passive escalator. Options dealers are structurally forced to buy the underlying dips to keep their books delta neutral, so it creates this illusion of perfect safety.
It is an illusion because underneath that calm surface, single stock volatility is absolutely screaming. The spread between single stock volatility and the index level VIX just hit an all-time record high today of 31%.
31%. That is a staggering disconnect. The index looks flat and safe, but individual equities are violently whipping around underneath.
We are officially operating in a highly dispersed stock pickers market. And the ultimate catalyst for that underlying volatility hits the tape tomorrow morning. We have to talk about SpaceX.
Right. Elon Musk's SpaceX, ticker SPCX, they officially joined the NASDAQ 100 tomorrow, and they went public back on June 12th, already swelling to a $3 trillion market cap.
This is the absolute focal point of the week for every institutional desk. But the quirk here is S&P Dow Jones indices refuse to fast-track SpaceX into the S&P 500.
Because of the strict gap profitability rules, right?
Exactly. SpaceX reinvests so heavily into CapEx that their GAAP net income doesn't meet the S&P's criteria for trailing profitable quarters, even though their cash flow is massive. So tomorrow, this $3 trillion behemoth only joins the NASDAQ.
Which means passive funds tied to the NASDAQ are forced to execute massive buy blocks today and tomorrow just to match the index weighting.
It's mandatory, price-insensitive buying.
Yeah.
But look at how active trading desks played it today. Knowing passive funds have to buy tomorrow, active managers spent all of Monday front-running and then fading that inclusion hype.
Right, using that guaranteed demand as their own exit liquidity.
Exactly. SpaceX opened strong, but active managers aggressively flipped their longs right into the passive bids. SPCX completely reversed intraday and actually closed down 0.7% on the session.
So active money is just exploiting the passive structure. But wait, if the broader breadth was weak, institutions faded the close, and the $3 trillion SpaceX closed red. What actually held the S&P up today?
The primary engine doing the heavy lifting today was Broadcom, ticker AVGO. They had a brutal technical breakdown last week, but today they reversed hard, surging 5.3% on massive relative volume.
And that wasn't just a technical bounce. Broadcom filed an 8K this morning, extending their custom ASIC chip partnership with Apple all the way through 2031.
Right, and you have to look at their revenue concentration. Apple is roughly 20% of Broadcom's total annual revenue. For years, the bearish fear was that Apple would bring all of its custom silicon design fully in-house.
Leaving Broadcom out in the cold, so locking in this specific demand floor for the next decade just obliterates that bearish anxiety.
He completely removes it. The market immediately priced out the risk of a severed relationship, and that makes Broadcom a critical day two play setup for tomorrow. By jumping 5.3%, the stock broke cleanly above its summer bearish decay trend line.
So you're watching for an entry on any early morning pullback toward Monday's breakout zone.
Exactly. Targeting a rapid extension back toward late June highs. And Broadcom wasn't the only semiconductor flexing real fundamentals. Micron, ticker MU, reclaimed the $1,000 mark.
Yeah, they closed up 3.27% at exactly $1,007.49. And just like Broadcom, this wasn't speculative retail momentum. Micron secured an auto memory agreement with Ford and officially broke ground on a $9.3 billion cleanroom expansion at their Hiroshima facility.
This is a major structural shift in the tech sector. The AI and custom silicon trade is maturing from the speculative hype of 2024 into locked-in long-term corporate commitments. Decadal supply agreements heavily insulate their downside risk.
That underlying cash flow certainty is exactly why real money is bidding those specific names up, even while they fade the rest of the market. And if you want to see what purely speculative momentum looks like when it hits a liquidity wall, look at Bitcoin today.
Oh, the crypto tape is a perfect contrast.
Right. Bitcoin pumped aggressively over the long weekend, nearing $64,000 when equities were closed. But the exact second U.S. trading hours open, it faded exceptionally hard, sliding all the way back down to settle near $62,110.
It faced a wall of institutional sellers. In a market environment where breadth is narrowing, capital is strictly seeking certainty, not sentiment.
So let's synthesize this. The narrative is a top-heavy mirage. Volume was light, breadth was negative, and institutions faded the close. What is the actionable, high-conviction setup for you when the opening bell rings tomorrow?
We need to watch the precise technical levels for the S&P 500. The index closed at 7,525.89 today. By doing that, it successfully closed above a massive options pinning level, the 7,520 gamma wall.
And a gamma wall acts like a massive magnet, right?
Right. Options dealers have so much exposure there, they are forced to buy and sell aggressively to stay neutral. By pushing above 7,520, the bulls converted that resistance into immediate downside support. If the index holds that 7,520 level tomorrow morning, quantitative models assign a 65% probability of a slow, grinding drift to test all-time highs.
But every setup has an invalidation level. What's the trapdoor where this whole mega cap structure falls apart?
The trapdoor is sitting exactly at 7,470. If the S&P breaks below 7,470, the summer rally is completely invalidated, and the tape falls right back into the June bearish decay channel.
And as you monitor 7,520 and 7,470, you absolutely have to keep your position sizes disciplined. We are walking into a gauntlet this week. PepsiCo's earnings will give us a read on the global consumer. Wednesday's FOMC minutes will reveal Kevin Warsh's framework.
And then Friday, the heavy hitters arrive.
Yeah, Q2 bank earnings kick off with JP Morgan and Wells Fargo. That underlying single stock volatility we talked about, it is absolutely going to find its way to the index level by Friday.
The compression of volatility never lasts forever, which leaves us with a massive structural question for tomorrow morning. We have a $3 trillion SpaceX forcing massive passive inflows into the NASDAQ 100.
Trillions of dollars benchmarking to it.
Right, but because of GAAP accounting rules, SpaceX is completely locked out of the S&P 500. S&P passive funds cannot legally buy it, while NASDAQ funds are contractually obligated to.
So because of this single $3 trillion anomaly, are we about to witness the NASDAQ and the S&P 500 structurally decouple in a way modern market history has never seen before?
It is a historic fracture hiding in plain sight, right beneath today's record highs.
We will be watching the tape. Thanks for joining us on this deep dive.